Hey there, everybody. Welcome back to the Carter Tomac Show. This is episode number 2, and today we're going to be talking about call reports for credit unions. If you just want to be an educated consumer on where you bank, then this would be definitely a thing that you can look at. So today I'm just going to show you how to kind of pull it up. What is it? What information does it have? And how it's important to banking and the overall economy as a whole. All right. So I have my screen shared over here, and basically this is the explanation of what a call report is. Well, it's a quarterly statement that's released by banks, credit unions. Credit unions go to the NCUA, banks go to I think it's the FFIEC, and they report at the end of each quarter what the bank's health is, their balance sheet, their income statement, and their cash flow. So this is just maybe a little bit of an explanation about what that is. So the way to pull up an NCUA call report is to go to the NCUA. So we're going to go there, and we're going to go under analysis here, and we're going to click research a credit union. By the way, this is really helpful if you are interviewing for a credit union job and you understand their call report and you're able to kind of spit numbers off depending on the position. You know, if you're interviewing for a teller role, it's not going to be that important. They're not going to be looking for that stuff. But if you're interviewing for maybe a higher role within a credit union or a financial institution and you understand their call report, they're going to instantly look at you above the other candidates because they're like, wow, this person knows what they're doing. And so this might be helpful for some of you that want to interview at a financial institution somewhere. Just to have this knowledge puts you above the other candidates. So it's going to pull up Amplify Credit Union, Austin, Texas. This is all public information. This is all reported as public information, so you can access this anytime you want. So here's Amplify Credit Union in Texas. We can see a few things when we pull up this page. We can see the charter year. We can see the date that it was insured. We can see where it's at. What we can do is we can pull up their basically any quarterly call report all the way back to 1990. So what we're going to do is we'll take a look at the most recent one. So this is the March 26th call report. We're going to hit download and we're going to wait for it to pull up. All right, so this is going to be what's reported every quarter from Amplify Credit Union. So it's going to show you a lot of different information throughout the call report, but the main things kind of to look for are total loans. How many loans does the credit union have? Well, they have 890 million. How many assets does the credit union have? Well, it's 1.2 million, almost 1.3 million. The balance sheet for a financial institution is the opposite in some ways from a personal balance sheet or a business balance sheet. And the reason why is because if I am the credit union and I make a loan to somebody, that's a receivable to me with interest, and so therefore it counts as an asset. If somebody gives me money that I have to hold in an account for them, that's then a liability because I got to pay that back to them a lot of the times with interest. So that's a little caveat. But as we look at this, we can see their total assets, we can see their total loans. If we scroll down, we can see their liabilities, and as you can see, deposits are in there. So total shares and deposits, they have 940 million. And then we're going to have things like equity, net worth. So as we dig into this, when I'm doing a research on a credit union for a loan participation or whatever I might be doing, I'm going to do this as part of my due diligence package. The reason why I'm doing that is because I want to make sure that the credit union is being run effectively, essentially. And so that way, if I buy a loan participation, which we can get into in another video, if I buy a loan from Amplify for my current workplace or wherever I might be, I want to make sure that they're making sound underwriting decisions, and that's going to reflect somewhat in their call report. Okay, so we can see their net interest income. Now keep in mind, this is through March 26, so this is basically 1 quarter of the year. So their net interest income is $8 million. We scroll down here, we can see a net loss. They have a net loss of $913,000, which obviously not great. Nobody wants to lose money, but maybe if we investigate this further, we can figure out why that's happening. So we can see how much their employees are expensed. So they're paying their employees about $6.7 million. We can see what they spend on travel and conferences and office occupancy and outside services and loan servicing. And so we can kind of see their entire picture here. So maybe we'll come back to this net loss later. As we work through this, it can actually break down the certain types of loans that they have on their call report. you're going to see things like unsecured loans, 18 million, new vehicle loans, they've got about 6.5 million. We can also see things like lines of credit or loans on a first lien, which is like a mortgage, 1 to 4 family residential property. I work in the commercial space, so I'm always interested in what other people have. So we're looking at now, these are average interest rates on here. This would be basically what their entire portfolio is as of March 31st, 26. We can see that they have $113 million in commercial loans or lines of credit that are real estate secured. Their average interest rate is 6.63. So when I'm looking at this, I'm like, okay, yeah, that makes sense. And the reason why it makes sense is because if it's real estate secured, it's likely going to be a lower interest rate just because it presents less risk to the credit union. So then we can go to commercial loans or line of credits that are not real estate secured. You can see right away that the interest rate's higher. And the reason for that is because it's not real estate. That collateral can get up and walk away if it wanted to. Maybe these loans are secured by a UCC filing. In a UCC filing, you can basically take over-the-road heavy equipment, non-titled vehicles, non-titled trailers, basically anything that isn't titled, you can put a lien against via a UCC filing. Some of this might be titled as well, like vehicles, heavy equipment, anything that has a title, titled trailers, stuff like that. So we can see there right away that their interest rate is a little bit higher on that. We can see the number of loans that they have. We can see the total number of loans that they have for their entire portfolio. So their biggest chunk is unsecured loans or lines of credit. The charge-off delinquency ratios on unsecured loans are a lot higher than other forms of lending. And so potentially what happened to their net income this year, if we look back here, so far this year anyway, is maybe they had some charge-offs here, maybe they didn't, but we'll kind of get into that maybe a little bit later. We'll see if we can't figure it out. This is their entire loan portfolio as of March 30th or 31st, 2026. We can see how many loans that they've granted year to date, which is 401 for $81 million. We can see if they have any government-backed loans, SBA loans, PPP loans, anything like that on the books. They're not really doing too much SBA, it looks like. Government guarantees, FSA, USDA, stuff like that could be part of this. Small Business Administration commercial loans, I guess they do have $3 million. And so they have they're doing a little bit of SBA lending. So Schedule A, as we work our way through this here, is basically delinquent loans and leases. It looks like a lot. It's not that complicated. Basically, the column you want to pay attention to the most on here and why it's highlighted is this one here. This is going to tell you out of this portfolio how many loans are delinquent. Okay, so they have a $900 million portfolio. They've got about 3.8 60 plus delinquent loans. So the way that I would calculate this is I would do a ratio, this divided by the total loan portfolio, which is this, and that would give me their essentially what amounts to their delinquency ratio. Okay, so that would be a key metric, because if it's too high, there might be something wrong with the credit union. Are their underwriting standards good? Are their internal policies, do they need to change those? Is there something else going on that we need to look at? This isn't really a cause for concern, I would say, because this is fairly low if I were to put this into a ratio. But another thing that we can learn from the call report is right here on the delinquent loans and leases. So as we scroll down, we can see charge-offs, which are different from delinquencies. The credit union has charged it off, which means it's off their books. They have taken their expected loss, and they're probably in active recovery, repossession efforts, foreclosure efforts if it's real estate, to try to get the money out of the collateral that they have against that loan. Unsecured, obviously, there's nothing there. Those are harder to collect. So this is going to tell us the total charge-offs and recoveries for year-to-date in these two columns. So here's the charge-offs, $258,000. There's also a charge-off ratio, which is helpful. I'm not going to calculate it in this video, but if you wanted to, you could. So they have $258,000 in charge-offs on a portfolio of, $900 million. So very low, right? So I wouldn't see a cause for concern here about their underwriting standards or anything like that. None of this says anything to me. I think their underwriting is in line. their internal policies are in line as well. Then we can see their recoveries. Well, this is normally a lot lower. This is like if they repossess some collateral and then they sell the collateral at auction. This would be the recovery that they get. This is normal. I'll give you an example. If this was like $1 million and this was like 50,000, there might be some issues, because now we can kind of glean from this information that maybe there's something wrong with their LTV underwriting guidelines because they're taking too much risk. So maybe they're giving out auto loans at 145% loan to value. Or maybe something else is going on. This doesn't concern me too much. This is very low. So as we work our way through this, we can also see like indirect loans, which basically you go into a dealership, you want to buy a car, but you don't want to go to the bank. So the dealership does all that for you. They'll farm it out to 40 different banks, and then you get approved indirectly for that auto loan, and they'll fund the dealer directly. And then you can walk away with the car. So that's like an indirect loan. Loan participation's part of my current job is when a credit union, say they originated a $10 million apartment building in Austin, Texas. What they would do is they would take part of that $10 million and they would sell off the principal balance to different organizations for a fee, and then it would spread out the risk amongst everybody. So they have this $10 million loan, they want to sell 5 and they want to keep 5. So they're keeping 5. And then they're going to sell it in $1 million chunks to 5 different investing credit unions. So it reduces the risk for Amplify, because now they, instead of having $10 million on their books, they have $5 million on the books. And it provides an opportunity for the purchasing credit union to make a little bit of revenue from a loan that they didn't originate. So that's what loan participations are. We can see loans purchased, loans sold right here. So we can see that Amplify hasn't purchased any. Well, they have. They've purchased, well, none year to date, but they have some that they have purchased, 146 for $18 million. We can also see that they sell loans, and so year to date they've sold 28 loans for about $10 million. But you can kind of get the sense of what we're looking for in these call reports. They're useful information. They come out every quarter, and it helps us assess the viability of the credit union involved. And so as we move on here, a lot of this is mumbo jumbo. It's got a lot of information. We can see fixed rates are, 15 years or less is 16.5 million, and they've granted 2.65 million in loans year to date. So back to our conversation about the net income of this credit union. We haven't really found out what's going on. Are they spending too much money? That's potentially a problem. And in order to really understand this, what you got to do is you got to look at their year-end call reports for like the last 4 or 5 years to really figure out what's going on. I know what's going on because I've done the analysis on Amplify for my job. They basically increased their loan portfolios exponentially from like 2020 to 2023. And then it kind of started, there's a lot of runoff, a lot of people paying off their loans, higher delinquencies, not really cause for concern. But there was a lot of people paying off their loans. There was a lot going on. And so Amplify just didn't have the revenue coming in from the interest on those loans because they were paying off. And so that, I think, is contributing to their net income, net loss figure. So with that question answered, and if you want to do this analysis, by all means, create a Google Sheets spreadsheet and just go through it. Might be a fun exercise for some of you finance bros or finance nerds out there like I am. So we can see a lot of different information here. You can see how many employees they have. Full-time is 210. They have 2 part-time employees. And so maybe you're assessing, hey, do I want to go work for Amplify? Well, you can look at this call report and you can bring up some questions like, if you're interviewing for like a high-level position, you want to know this. You want to make damn sure that you've done your research, because you want to walk in and say, here's what I can do to fix this. Are we retaining employees? Do we have too many employees? Do we have too little employees? There's a lot of things that you can glean, a lot of information from these call reports that you can take into that interview and do well with. So this is more geared towards people that are in the financial industry that maybe don't know this, and they can look for it when they interview for higher level positions as their career progresses on. Another good figure is net worth here, which is on page 26. We can see the net worth of the credit union. Most credit unions have policies that are governed by the NCUA that basically say that they can loan up to 100% on indirect auto loans against their net worth. And so if that was true, then they could lend out $136 million on indirect auto according to policy, and only up to that much according to policy. So if they wanted to do 200% in commercial loans based on their net worth, they could lend out $272 million. ish. So that's what this can tell you here. So again, just a kind of a broad overview of information that's on a credit union call report. Banks are different. That could be a different video, but those are through the FFIEC. So if you guys want to do that, you want to do some research on different banks, you can also look at the FFIEC call reports, which govern banks. Thanks for watching. This has been episode number 2 of the Carter Tomac Show. Appreciate all you guys for listening. And if you found this information useful in whatever capacity, please like and subscribe. I'm going to have more of this content coming out all the time. Not only this, but we're going to talk about pretty much everything with a lot of different people on this show. And so it'd be helpful if I could grow that audience and begin to develop a community. And we'll see you guys next time. Thank you.